So thanks very much for coming along this morning. You've no doubt seen the budget, heard a little bit about it, and seen maybe the reply last night from Bill Shorten. I'm going to talk through a number of the key announcements or the key proposals that came through in the budget, and basically the application and how we might be able to sort of get some advantage for our own personal circumstances from that. It's important to realise though that things that were announced on Tuesday night are proposals at this stage, and they still have to be legislated, and if the current Senate discussions around last year's budget sort of announcements or anything to go by, it'll be a pretty difficult ask to have a number of these initiatives legislated. So the important thing to start with any presentation from a financial advisor is the good old general advice warning. And what that basically says is what I'm talking about today is pure factual general information. If you want to compare how this information might apply to your personal circumstances, it's a matter for personal advice, and that's best done one-on-one rather than in a group situation. So basically, as I said, the budget was handed down on the 8th, which was Tuesday night. We've had the budget reply last night, and I'll talk a little bit about that. Compared to 2016 and 2017, the scope of the proposals are really kind of fairly lightweight. They aren't as world-changing as the previous years, but notwithstanding, there's some advantage that can come from that, and it also gives the opposition something to talk about as well. So first area that most people are usually interested in the budget is taxation, and there are certainly some changes that have happened there. So with regards to probably the most controversial matter of the Medicare levy, we've basically had a stay of execution in terms of that increase in the Medicare levy to pay for the NDIS, on the assumption that we've got greater tax receipts coming into the government. There is now apparently not the need to implement a funding mechanism for the NDIS moving forward, which, depending on where you sit, is probably a little bit short-sighted, because the NDIS really isn't about funding people for 1 or 2 years. In a lot of cases, the families that are looking to get some funding from the NDIS have generational needs, have decades of need, and it's not about we've got great tax receipts so we don't need to put in place a process now. So political expediency, I think, won the day, which is a little bit difficult. The other thing that's from a small business perspective that's quite good to hear is that they're extending the 100% asset write-off again. So that certainly is a help to small business. There are still business tax cuts that are sitting in the Senate from last year that, as I said, are sort of very difficult to have those legislated given the hostility of the Senate. But there are now some personal tax cuts to add to that as well. So the Medicare levy stays where it is, and it's been formally abandoned. So the tax cuts that I talked about, it's quite an interesting development that the government has gone with. There's certainly a short-term win with regards to tax cuts, but it's not something that people are going to see in their take-home pay on a fortnightly basis. The basic thrust of the tax cut will come as a result of a small change will come from the indexation of the tax brackets. So we go in this one here, the 32.5 cent bracket is the one that seems to change most. We go from 87,000 as the top of that band to 90,000. So that'll give a small tax benefit that will happen from the 1st of July of 2018. But what is proposed is a much wider sort of reconstruction of those tax brackets as time goes by. So the next key date is the July of 2022, when we see that 90,000 being the top of that bracket move out to 120, and you actually have to be earning 41,000 to get in the 32.5 cent tax bracket from that time, which is again a little bit of an extra saving. But the biggest change is the proposal to actually do away with completely the 37 cent per dollar tax bracket from 2024. So what that basically will show is that in 2024, the 32.5 cent tax bracket will range from incomes of $41,000 a year right through to $200,000. So it's a massive change, but it's such a long way down the track. We probably have had the government change 2 or 3 times by the time we get there, so it'll be very interesting to see the fate of this proposal. There are certainly some savings on offer as you move up the tax bracket. So next year, there's not a lot of savings, as I sort of mentioned there. In that $80,000 a year tax bracket, we're looking at the savings sort of peaks in that 37 cent sort of tax, 32.5 to 37 cent. So we get $530. But from 2022, we start to see where the savings start to add up is in those higher income levels. So 120,000 up is where those savings really start to happen. And when we go out to 2024, there's certainly some meaningful savings that happen if we get to that tax bracket change. So it's interesting to see the strategy from the government. Is it enough to keep a government in power in the expectation of these changes in the tax brackets? I don't reckon it is. But so the other thing that's happening is we've already had the low income tax offset. Now they call it the low and medium income tax offset, and that comes into apply from the 1st of July of 2018. And what happens is that you get a tax offset, which is basically how those tax savings will be received. So you do your tax return, you get an offset, and then you get a potential refund, rather than getting a benefit on the fortnightly basis on the way through for most of those tax offsets. So yeah, up to $530 based on your income, and so this will be increased in 2022. Got the full slide up there, from $200 to $645 as time goes by. And that's the upper limit of the 19% tax bracket going to 41,000 is the catalyst for the increase on that benefit. So that's none of this is very big stuff. It's all a lot of little things put together. So the extension of the immediate ability to write off assets up to $20,000 has been extended for businesses that have got an annual turnover up to $10 million, and this will be extended for another 12 months until June of 2019. So that's been a help. I've got a group of a networking group, BNI group, that I go to. We've got a car broker as part of the group, and it's his best time of year. It's between budget and the 30th of June. And knowing that this has been extended into the new year, it's happy days in that business as well, because there are a number of cars that sit in that just under that $20,000 mark that you can actually buy for your business. So superannuation, that's always a feature in budgets, and while we haven't really had the change in super that we've had in previous years, there's certainly things that can be thought about and things that will be an advantage to people. So one of the big things as a financial advisor we see are a lot of people that keep small balances in small superannuation funds to maintain insurance cover that has been provided as a default option. And you know, that the issue with that is that you ultimately find people with numbers of superannuation funds around the ridges. So basically the change that's happening from the 1st of July is there will be the need for some members to opt in to insurance cover. Generally, if balances are below $6,000 in the super fund, there will be the need for members to opt in. So super funds will be communicating with clients to ensure that they either maintain the balance or, you know, make a decision about whether they have their insurance cover in their super. And potentially, in a practical sense, there are a lot of people out there that have had health issues and things that prevent them from getting cover that is at standard rates. So this is an area for a lot of caution to make sure that people who need the cover can continue to maintain their cover within their default superannuation funds. So there has always been also a work test requirement for people to make super contributions post-retirement. So post-age 65, you need to have been working 40 hours in a 30-day period to be able to make a superannuation contribution into, you know, that might be about, you know, offsetting a capital gain by making a concession or a tax-deductible contribution, or if you've sold a big asset, you might be able to make a non-concessional contribution of up to $100,000 in a year. But over 65, you've had to satisfy that work test. Now, the proposal has been put that if you've got less than $300,000 in super, the need to satisfy the work test in that year after you finish work has actually been made exempt. So you don't need to satisfy that work test if this proposal comes through, which is quite a great strategy, because as a financial advisor, you do see a lot of people that are restructuring their situation, selling investment properties, selling businesses, and just generally setting themselves up for retirement in that 12 months after they finish full-time work, and hence have a lower income to receive any capital gains, and hence can restructure themselves with a reduced amount of cost. So this is a good proposal. The other thing that's happening for those of you with self-managed super funds, there's a proposal to increase the number of members in self-managed super funds up to 6, which is a handy addition for families, for example. So mum, dad and a couple of kids, you can actually have more members in the self-managed super fund under this proposal. And I don't imagine there'll be any changes with regards to that particular initiative. There's a reduced audit requirement for self-managed super funds. At the moment, self-managed super funds need an audit every year with the preparation of their financial statements and submission of tax returns. Provided there's been no issues with that fund, there is now the proposal that that audit is only required every 3 years, which will save a little bit on the compliance cost with regards to self-managed super. There are also some changes in terms of inadvertent concessional cap breaches. So when you make superannuation contributions over particular caps, so if you're making salary sacrifice contributions in addition to your employer's super guarantee, or you're making self-employed contributions that you're claiming as a tax deduction, there is the proposal now to, for example, if you're employed, you can actually have your employer, if you're over from a number of different employment sources have an income of over $260,000, there is the ability for you to go to your employer and say, don't make any super contributions for me, so that you can avoid inadvertent cap breaches of that concessional cap and hence go into the sort of penalty tax area. One of the points that's pretty important to us in financial advice that has probably been missed in a lot of the commentary as well is another announcement that came through that gives the trustees of super funds the requirement to actually start thinking about I'll just go down on my notes. Comprehensive income products for retirement are a new concept, and the government are trying to put in place the framework so trustees have to consider development of these products. They're called SIPPers. You may hear about them as time goes by, but essentially one of the big issues with superannuation has been that if you have a market correction like we had with the GFC, people retired before the GFC, balances drop 30 to 40%, so hence they start their retirement behind the 8 ball and their money doesn't last as long as they need it. So longevity risk is a big thing with superannuation, and one of the things the government have asked super trustees to consider is how they might help people address longevity risk. And these new products, comprehensive income products for retirement, put together a number of different types of financial product that we already have. So we already have lifetime annuities, for example, which are basically provide a certain income for a person's life expectancy, whereas superannuation allocated pensions, account-based pensions, which are, the sort of just like a water tank where you turn the tap on, and depending on how much rain you get in, depends on the balance. The rain is the investment return. So you're reducing the risk of just relying on the rainfall to fund your superannuation if you've got part annuity within that, and that's what these comprehensive income products in retirement are all about. And we'll see more of those, and the framework was actually put in place. So I think that's pretty important sort of going forward. So this is that opt-in. So proposed from, so if you've got less than $6,000 and people who are less than age 25, and if your account hasn't received a contribution in 13 months, then you have to opt into the insurance cover. And it's due to commence on the 1st of July of 2019, this one, so we've got another year of leeway. This gives individuals, the 14 months between now and then to consider whether they want to have that insurance. So it's important that if there are people out there, they seek some advice as to whether insurance is right for them at this point in time. The other welcomed initiative is a reduction to reduce the fees, the impact of fees on superannuation. There'll be protection will be provided by limiting administration and investment fees to a 3% annual cap. Now that'll be a fairly sophisticated type of investment strategy to determine a fee of 3% per annum on a super fund, not even with the cost of maybe getting some advice is likely to get to sort of 3%. However, it certainly does provide some protection for balances, and it'll apply to balances of less than $6,000. And one of the other impacts that hasn't really been talked about in the budget, but what is coming, is the impact of insurance premiums on superannuation as well. There are a number of super funds where people are paying premiums for insurances, maybe inadvertently, maybe not really understanding what they have, where the insurance premiums are making a big difference and are making a big impact on the balance in the super fund. So the government have got that in hand, and that's following the Royal Commission. There's certainly one of the next courses of action that ASIC is tasked with is running and implementing the outcomes of a review into the impact of insurance premiums on superannuation. So that work test being deferred is another important one, as I talked about. That'll be deferred for people for that first year post-retirement if their balance is less than 300,000. So that's going to be very helpful. So self-managed super fund, currently 4 members. We're going to 6 members, so that just helps families like mine where I've got 4 kids. There are a lot of families that have 4 kids, and for some people it would make sense to have the kids join the self-managed super fund, and this just gives a little bit of extra flexibility. 3-year audit cycle, which I've talked about. So that's the audit. 3 consecutive years or clear audit, on-time lodgement of annual returns. So it's just a reward for being well behaved. So individuals, this initiative is all about the reduction of the impact of cap breaches. So if an individual has a total income exceeding 263,157 from multiple employers, they have the ability to go to the employer to cease the super guarantee contributions, and if they're lucky, the employer will give that amount to the employee as extra income that obviously will be taxed at those top marginal tax brackets. But of course, it'll be a matter for discussion with the financial advisor, because if you do breach that concessional cap, there is the ability to have those excess amounts refunded, provided you act within certain timeframes and follow a certain process to have that done. So, we really need to weigh up the impact from a tax perspective of breaching that concessional cap for those people that are well into that top marginal tax bracket, because there isn't a lot of difference between the penalty and the actual breaching the tax bracket anyway. So again, it's all small stuff. It's not really earth-shattering change that we're seeing in this budget. Social Security is another area where there has been some changes. Again, small changes. There has always been the ability to have, some support from Centrelink around getting a loan. So there is the ability to have an amount paid on a fortnightly basis that is in excess of the standard rate of pension, and that excess amount accumulates as a loan that is secured against the pensioner's home. There are a number of options for funding people's lifestyles in retirement where there hasn't been enough superannuation contributed. Up until sort of fairly recently, reverse mortgages have been something that has figured in the landscape. There are disadvantages and advantages. Probably in my mind, in my experience, the disadvantages of reverse mortgages outweigh the advantages. So if there is only a small amount of extra cash flow required, maybe a pension alone is the right thing for people. But basically it allows people to increase their pension to 150% of what they would normally get and build up that 50% as a loan over time that will be paid off at the sale of the home. Just bring it all up. So fortnightly loan extra builds up the loan over time. So what that means is you can increase your annual payments by up to nearly $11,800 a year, or $17,787 a year for couples. which means that a couple can actually get an income of up to $53,650 full age pension plus that maximum loan over time. But as a financial planner, it's always a discussion that you know, a lot of clients that are in that position that are considering that type of option, they will want to have that discussion with their family, because obviously if there's someone that's going to have a loan repaid from the sale of a house before that house is split among the beneficiaries, it certainly changes the outcome that they may not have sort of expected. So the income test and asset test determines pension eligibility, but where people are actually still doing some work, there is the ability to disregard up to $250 currently of income from per fortnight from people that are still working. So what has been proposed is the from the July of 2019 is that $250 amount that can be disregarded moves to $300 a fortnight. So not a lot, not a big thing, but it does help a little bit. It certainly helps with a number of my clients to increase the amount of age pension benefit. If they're just doing a small, you know, might be working at a golf club or might be working, you know, just sort of helping out kids in their businesses. It does $7,800 is really the annual amount of income that can actually be disregarded. And it works like a bank. So basically you may not earn your $300 in one fortnight, but if you don't, then you've got more to take from the next fortnight. And as long as it's less than $7,800 for the year, it makes it work. The other thing that's changing is the only income that will be eligible for that work bonus will be physical exertion income. So up until now, there hasn't been a specific quarantining of physical exertion income. So there's been income from other sources, trust distributions and that type of thing that may have also been considered in that work bonus. Now it's very specifically about physical exertion, and there'll be some tests that will apply to make sure that that physical exertion income is the only income that applies there. One of the areas where I've been doing a lot more work of late is aged care, and there have been some changes in the budget, but again, following the theme of the budget generally, the changes have been fairly lightweight. And knowing the wave that's coming through with regards to people needing aged care, the baby boomers moving through, you know, their late 50s into their 60s, they're not too far away from potentially needing some aged care support. A lot has been made of the funding increases to home care packages. When the aged care system was rejigged significantly in 2014, one of the focus areas was an increase in home care as opposed to residential aged care. But up until now, we haven't seen a lot of extra money to provide more places. So over the budget, we're talking funding to provide an extra 14,000 home care packages over the next 4 years, and additional 13,500 new extra places for residential aged care over time. When you consider that for home care packages alone, 20,000 Australians hit the waiting list every 6 months, and we're talking about an extra 14,000 places over 4 years, there's not a lot of extra money that's going into this system compared with the demand that's happening now and will increase over time. So again, token measures that really, there has to be the way these things are funded really needs fundamental addressing. It needs to be addressed. We really don't have that full review of the tax system that our economy has been crying out for probably the last 10 years. Just we're tinkering around the edges. We need these priorities solved over the longer term, and we're not getting the revenue to be able to make meaningful change as time goes by. So, opportunities, a little up. Too many animations. So, super continues to be an opportunity or advantage for retirees. It's part of an overall mix, and I think over the last few years the government has recognised that super isn't the be-all and end-all, but certainly is an important factor in retirement income. Super is changing. There's more flexibility with the changes with self-managed super funds that will allow people to consider their personal circumstances and see if there's an opportunity for their family. It might assist with their succession within the self-managed super environment, allow them some wider investment choice that may suit a family's objectives. For the people with smaller balances, there's increased protection, both from a fee perspective and outside of the budget environment. The impact of insurances will be considered against superannuation. The opportunity there, though, is for people to have a look at what they actually need. It's another dig in the ribs for people to maybe have a look at the 3 or 4 super funds that they may have accumulated over the last sort of 10 or 15 years of work and decide exactly what they need. Are they paying too much? Are they paying for insurance that they don't need? And then just do some rationalisation. It's just another opportunity for people. Tax cuts are really nothing to speak of in the short term. However, if by a slim chance we do have those tax bracket changes that are being proposed, it certainly will provide some major savings over the longer term. Again, nothing in the budget about funding long-term priorities. So at the end of the day, between now and 2024, there'll have to be some way that we can address the needs that we have, and aged care is particularly one of those ones that I think has gone begging. Same with the NDIS. Because good times don't last forever for those people that have been around for the GFC and the tech wreck in 2000 and the 87 crash even. Good times don't last forever, and there are things that will derail revenue that we're budgeting and expecting. Social Security, again, it does help people in that social security environment to have some flexibility to get some loans to assist with their income needs. It will help also for people that are doing part-time jobs to supplement their income, to have less of that income counted in their means testing for the pension amount. But again, these are matters that, while they're small, the role of someone like me is to sit with clients and see how we can put a number of these initiatives together to produce something meaningful and give some change, and to give some opportunities for people to save money and have a better lifestyle as a result of what's put on the table. We're talking about that with our clients now. We've certainly got a number of things to talk about, as we always do, with regards to the budget. The wider financial landscape is one where I think we're certainly seeing companies doing a lot better than they were. However, one of the assumptions, I guess, that's predicated having the money to do these extra changes down the track is an increase in wages growth that really hasn't happened up until now. And unless that happens, we don't have people paying more tax. We don't have people spending the extra money that they're earning in wages. We just have increasing corporate profits, which, while are great for people that are in business, don't necessarily drive an economy terribly well. So again, we need to see what's proposed with regards to increasing this wages growth, because there's quite ambitious targets that these budget initiatives are proposed are based on, and unless we get that, it's unlikely that we'll be able to afford what we need to do. So hopefully that's given a little bit of sort of overview of where the budget is. Bill Shorten's immediately come out and said, you know, for your $450, $500 tax saving, we'll immediately give you a $900 tax saving, but certainly we've got to get him elected. He's got to be elected first, and again he'll have a Senate to overcome as well. One of the interesting things, just as an aside, we're basically in a unique position in that we're going to probably get the biggest idea about what the electorate think about these changes, because we've got 5 by-elections that are going to be happening in the next month or so. A super Saturday of by-elections where we're sort of trying to see if the foreign nationals or the foreign dual citizens can actually get back into Parliament, and both sides will be looking at it as validation or otherwise of the budget initiative. So it'll be interesting to see how it goes. So thanks very much, and does anyone have any questions or comments at all?
I have 2 questions. One relates to me, one relates to probably everyone else in this room. Are there any major changes in the budget for first home buyers, and are there many changes for people who own investment properties, particularly like towards negative gearing?
Not in the budget for either of first home buyers or with negative gearing. However, in the reply, Bill Shorten has talked about, particularly on the negative gearing side, there will be changes to negative gearing should the Labor Party be elected. Again, it's not a well-defined proposal at this stage. Negative gearing is certainly of use for people that buy property, but there's also the ability to borrow to buy investments as well. Whether or not the change extends to investments as well is not well known as yet, but certainly there will be changes in that area if Bill Shorten and Labor Party, well, the Labor Party and whoever might be there is elected. So yeah, but first home buyers, there's still some incentives that are available with regards to, you know, stamp duty remission and that type of thing that are available on a state by state basis, and there are different schemes in each state. So hopefully that'll continue on.
Just on that, so what's the take up with the first home buyers using their superannuation? Has that been enforced? It's tapping into their accounts at this stage.
They're really, and what you're talking about there is the ability to make contributions into the superannuation environment for the express purpose of being able to use the concessionally taxed contributions to come out and form the deposit for homes. It hasn't really been very well, not promoted, it certainly hasn't been promoted terribly well, but it certainly hasn't been taken up with any great gusto as well. It seems like it's a complexity for people to put money in and then take it out of their super when everyone's told them over their life that super is for retirement. So we really haven't seen a lot of people that have been interested. It does give you a tax benefit, but generally first home buyers, the amount of tax savings because of the income that they're on, the alternative is to receive that income, pay a marginal rate of tax and then put that money in the bank versus, say, for example, salary sacrifice that income into superannuation, pay a contributions tax, and then so that the differential isn't that great until you get into the higher tax brackets anyway. So, so we haven't seen a lot of that.
Is there any noise in the budget about the government cracking down on SNSFs using buying property using the LBRA?
Limited recourse borrowing. Yeah. Again, there hasn't been any specific noise. in the budget, and it's really something that has been particularly, the opposition have been particularly vocal on.
Yeah.
There is a lot of conjecture as to whether the ability of super funds to buy residential investment properties particularly has actually fueled the property boom that is keeping first home buyers out of the market.
Yeah.
I would be of the view that certainly in some areas that might be the case.
Has Bill said he's going to ban it if he gets in?
He had made that comment a couple of months ago that limited recourse borrowing. I mean, if they can't, I wouldn't imagine that they'd want to throw the whole thing out, because there's certainly some opportunities for people, for example, in business to buy business premises with limited recourse borrowing, and that's still a legitimate strategy for people. I think limited recourse borrowing for residential investment properties in a lot of cases has been oversold and badly sold. There are a lot of property organisations that have actually jumped into the bandwagon, and there are a lot of properties that have been sold in places like South Brisbane and Gladstone, and Moranbah is another one that's been particularly popular for property spruikers that are using SMSFs. And there's certainly people that are hurting quite significantly from reductions in not only valuations of properties but also rental returns due to massive.
And for ask another question, small business company tax cuts. Has Bill Shorten said anything about those tax cuts that the government's done? I think for small businesses.
Generally, Shorten's view on the small business tax cuts. For under $50 million seems to be the benchmark. So under 50,
that's good.
yeah. So if you're under 50 million, you're most likely. But still, we still haven't seen like that program of tax cuts being fully legislated.
Yep.
They're actually getting caught up on the 50 million plus. So the big organisations, the big end of town, as Bill calls it, and particularly the banks is the one that he's largely jumping on at the moment. Why should we be giving the banks tax cuts?
So $50 million plus, basically, you're in trouble.
You're in trouble. Yeah.
I'll be okay with a lot.
But the issue is it's holding everything up. Hopefully we may get some sort of more clarity as time goes by. But it's still, to my mind, not the root and branch tax reform that's required.
GST.
And
it's a whole development, whether it ever happens.
I've been going to the PricewaterhouseCoopers budget breakfast at the ECA for the last 4 or 5 years, and every year they get up and say, missed opportunity, we should be going root and branch. Like Ken Henry got up there in 2010 and proposed a whole lot of changes. There are about 3 out of 50 that have been implemented. And, it's political expediency, it's that short-term cycle that is preventing real change, which is quite disappointing.
Yeah. That might take another generation.
Absolutely. I think so. Better minds than we've got there now, I think.
Do you foresee the Royal Commission getting in the way of the budget actually getting passed, if there's enough steam kicked up?
I wouldn't say that it would. Certainly, so far, we're talking, mortgage brokers, the role of professional organisations that professional standards for financial advisors, and also the vertical integration of financial advisors, the model where banks own distribution as well as product provider. So as far as impact on different budget initiatives, I don't think there's anything, but that'll certainly be a very interesting presentation to come along to here about the Royal Commission. I think I like a lot of financial advisors watched a bit of the live stream as it was all sort of taking place, and some of the behaviour is just absolutely out of this world, unbelievable. Very sad, but we'll, we've got to sort of continue to work with our clients. From my perspective, I've been sort of keeping my clients informed as to the outcomes from the Royal Commission, and in businesses that are very personal type approach, where you actually sit down on a, you know, a half-yearly or quarterly basis with all of your clients, really haven't had much impact. It's really about those new people that should be getting advice, that are unlikely or less likely now to seek out a financial advisor because of a lack of trust. That's the real crime. That's the real disappointment, and that's the thing that needs to be addressed, not only by big organisations, but by all of the people in financial services.
Or if you did.
Or if you did.
Or if you did.
Yeah. Yeah.
I guess, as you said, the forthcoming by-election might be the good indicative of
That's right,
people
yeah.
think. But how do you rate this year's budget from, I guess, your point of view?
Just tinkering.
Yeah.
No, from my perspective, another missed opportunity to do something more, to do something bigger. It's not necessarily about tax cuts, and I mean, and
It's
I
all
think
very political, I guess.
it's all very political, and you know, I think it's a misreading of the sentiment, particularly on the funding of the NDIS, because we've all got people, we've all got family members that are, you know, that are in need of this NDIS. I've got clients, I've got people in my family that will benefit from NDIS funding, and over, you know, since the change of government. I'm not saying that, you know, we'd have a much better outcome with balancing that near-term priority versus the long-term with Labor, you know, but we might. The rush of excitement about what might be covered with the NDIS has really abated over the last few years as the reality of the lack of funding has set in. And, you know, with this 2% going to 2.5% on the Medicare levy to provide extra money not now happening, I just sense that that's also going to take a lot of the wind out of the sails of the NDIS as well. There has to be long-term funding, decades, not just in the next sort of, you know, political cycle. So yeah.
So technically there's got to be some revenue raised from somewhere there.
Yeah.
And you mentioned about the increase in the Medicare levy. Well, would that sort of make a more argument to maybe bring in a GST? It's because there's income coming from somewhere, isn't
Yeah.
it?
The issue
I
with
don't know, I'm just asking.
well, the issue with increasing the GST is it's got to have some agreement around the states.
Or broadly,
And the states get a take of that GST revenue as well. So it's a maybe that whole model needs to be looked at in terms of where that money goes and how it's spent. But that's certainly got to be one plank of how they fund these long-term priorities. With a broad-based consumption tax, which is a great idea to start with, but it needs to be progressive and keep up with the way the world's moving.
Because I mean, so this year certainly there wasn't really much of tax cuts as
No,
as
not
also
now.
No revenue raising.
No, it's all the promise of what's happening in the future, really. I mean, they're doing...
It's just, you know, my son's excited that by 2024, whatever, you
Yeah.
get those cuts, but I mean...
Yeah.
That's right.
Well,
Could be
they're
empty promise, isn't it?
they're cracking down on people that try and avoid the excise on tobacco again. They're cracking down on corporate profits from the Apples and the Googles and the Ubers again. We have had these over the last 3 years. We're doing something about eBay, we're doing something about Google, we're doing something about Apple, and now we're still doing something about it, but our tax revenue isn't increasing. So, yeah, it's quite sort of, yeah, it sort of doesn't give me a lot of faith in the political process. We're saying the right things, but we're not actually getting a result. So.
I guess try to please everyone, but it's actually
That's it.
upsetting about the same time of doing it.
Yeah, yeah. We just have to see what happens.
Yeah.
Just a quick plug for Diet. We're collecting for the Zoe's Angels. There's a box at the back if you want to give a $10 donation. And my mum actually works and